everyone. It's October 2nd, and you are in Ask Athena Anything. And today is a very good topic. We're going to talk about the 3-2-1 buy down, and we are going to debunk the myth on why this is such a great tool for everybody. The 3-2-1 buy down is a great tool, but we're talking about a very select audience, and we want to make sure that you have a full understanding of what that encompasses. My name is Athena Chalikas Barocas. I'm a top producer and award-winning realtor with Coldwell Banker here in sunny South Florida. And if you know somebody who's thinking about buying a home, this could be a great video to share. So let's get to it. I have my guest speaker, Arturo Sanchez from Guaranteed Rate. Arturo, nice to have you here, and I'm very happy that we're going to be talking about the 3-2-1 buy down.
Absolutely, Athena. Very nice to be here with you. Thank you for the opportunity to share some insight to your customers.
Absolutely. But before we get started with the 3-2-1 buy down, let's talk about the rates. Last week, we hit the high as far as what we've seen over the last 2 years. Tell me what that rate was and what do you think happened?
Well, what happened basically is, the rates, interest rates for mortgages are guided by the treasury bills. And when the treasury bills, the yield on the treasury bill, when that goes up, then interest rates go up. Interest rates really aren't, for mortgages, aren't really affected so much by when the Federal Reserve raises their points or interest rates. When they raise it, that affects more personal loans, car loans, credit cards. Then those bump up a little bit. The Treasury and the sale of Treasury bills, when the interest rate on those, the yield on those goes up, that's when we see the interest rates rising, and that's when we're kind of like frowning because last week they jumped all the way. If your customers, when they go into the internet, they can just type in 10-year Treasury bill yield, and it'll give you a number. It'll give you numbers. In last week, it went all the way up to 4.5. When we want to guide ourselves and more or less have an idea where interest rates are at that particular point in time, we just add 3% to that, and we have an idea where they're at. So it was 4.5. So now you're looking at 7.5, almost 8% in interest rates. Before, a long time ago, when we went through 2008, and you asked me to speak a little bit about that.
We'll get to that, but yes,
Yeah,
in 2008, what were the interest rates like?
the interest rates in 2008 were pretty much in the fours, and then what
Yeah,
was happening there was we'll get into that later. But what was happening there,
a little later,
yeah,
yeah.
that was a fiasco, and
It was.
yeah,
And today, a lot of buyers, they're a little nervous. Okay, so we hit almost 7.5,
right,
and we're expecting per the feds, what they're signaling is we're going to have another interest rate
yes,
before the end of the year.
yeah,
So we would be knocking on 8% by the end of the year.
right.
That wouldn't be an outrageous prediction.
Right. I think that's something that is very real. But I think what's happening also is that if we focus strictly on what the interest rate is, if our future home buyers are looking at it as, what am I going to do about this? The interest rates are high and what have you. There's nothing that we could do about the interest rate ourselves. So, what is really the driver in making a decision when you're purchasing a home? At the end of the day, is going to be, can you afford the mortgage payment? And
Exactly.
how do and
That is it,
that is it.
you know.
That's really the driver. And how
Mhm.
do we get that mortgage payment to an affordable amount where we can focus on that? And what we do is we go through options such as the 3-2-1 buy down, where they're temporarily buying down for the first year to 2 years of the loan. They're buying down the interest rate, which in turn will lower the payment that they're going to be making temporarily. And then that cost is passed on to the seller through a seller credit. So that's a good option.
Sometimes.
Sometimes it's the seller accepts.
Sometimes,
Sometimes it's the
and
seller
we have to
accepts.
be careful about that
Yeah,
because different markets, right?
yeah,
Right now, we're in South Florida. We are still in a hot seller's market
yes,
because we have strong buyer demand.
correct,
And
correct.
uh, we talk about the interest rate. You brought up a great point. What can we do about it? Nothing. We can't manage the interest rate, and we can't manage what the cost of homes are.
Right.
And here in South Florida, we're going to continue to see, and I know you agree, Arturo, we're going to continue to see a strong
Yes.
appreciation on homes.
Yes.
So as a buyer sitting out there on the fence going, what do I do? This is what I say. And I don't think you disagree with me. I say buy the home because
Yes.
you're going to pay 4 to 6% more next year for the same home. And the interest rates may or may not change. But the one thing you can do as a buyer is you can refinance.
Correct.
You can buy down your rate. You can make the loan, as you said, more affordable
Correct.
on a monthly payment structure.
Correct.
And that's why I'm so excited about this podcast. And that's why I'm so excited that you're here, because buyers are out there. We have so many sitting on the fence,
Yeah.
waiting for rates to drop. But when the rates drop, whatever that looks like, we're going to see multiple offers on homes.
Yes.
They're going to be overpaying above appraised value.
Mm-hmm.
This is what's going to happen. I've been in the business 20 years. Arturo, how long have you been in the real estate business,
I've been
whether it's on
I
real
used
estate
to
or
have I
loans?
used to have my own real estate license a long time
Oh,
ago.
I
So
remember.
I'm very familiar. Been living in South Florida for over 50 years now, so I'm very familiar with the area. The weather, of course, we know that that's something that people are attracted to, and what have you. I think what I see for the market itself is like I don't see a deceleration of prices. I don't see prices going down anytime significantly. There's too much demand out there. And because of all the options that we have when purchasing a home, as far as, and I like this particular one, and if you allow me to get into it a little bit, I like the permanent buy down versus the 321. Why do I like the permanent one? We can realize a savings on the mortgage payment immediately if the buyer looks at it from the standpoint of you're prepaying interest. Yes, you are prepaying the interest that you would pay normally through your mortgage payment, but you're realizing sometimes in a lot of cases anywhere from $200 to $400 of mortgage payment savings every single month. And then if we look at it where, okay, you're putting down 1%, a point, when you're buying a point, you're buying 1% of the loan amount, not the purchase price. A lot of people get that confused. All right.
Right.
It's the loan amount. So whatever the loan amount is, and you have enough assets to buy points, you can significantly lower your mortgage payment anywhere from 200 all the way up to 500 a month, depending on your loan amount. And your payback period, if you're getting if you're realizing, when we analyze the savings, we multiply out the savings per month and we compare that to how much money you're buying down in points. If you're able to get to break even point within 2 to 3 years, then the rest of the loan you're realizing that savings of your buy down, okay, of buying those points. And I think that is significant in a lot of cases. A lot of my buyers are looking at it from that standpoint, and that really helps. And what I do is I do the analysis for them. And they
Mm.
see exactly where the savings are, how long it's taking them to get those savings back in their pocket. The investment that they're putting up front, with those savings, they're getting that money back to break even from the investment that they're putting into the buy down. That's one of them.
Oh, absolutely. A permanent buy down, in my opinion, is the way to go. We're going to
Yes.
get into the 321 in a moment, only because there's so much hype. I roll through, and you do too, and all of our buyers and all of our listeners do. You're rolling through social media. 321, 321. Get your 321 today. There's so much misadvertisement out there
Yes.
on the benefits
Yes.
of this. So you had mentioned something very, very important, the break even rate.
Yes.
And I do have a video on my podcast regarding the break even rate because it's so important.
Yes.
You're buying down a permanent rate,
Hmm.
2%, 3%, whatever that is that makes your loan affordable.
Correct.
As Arturo had mentioned,
Hmm.
what you're doing is you're prepaying interest.
Correct.
Yes. But the beauty of this comes when you know you're going to be in your home X number of years,
Right.
7 years. If you're in your home 7 years and you do a permanent buy down and you break even in year 2 or year 3, 4, 5, 6, and 7, you just made money.
Exactly. A hundred
Right? You
percent.
can say I saved money, but you also made money because you beat the bank out.
Right.
Uh, I know, Arturo, that's not the best way to say it, but it's true. You beat the bank. If you stay in your home 15 years, your savings is an enormous amount of money. And, when we had our free interest rate, 3%, nobody was buying down the rate. There was no
No,
buy
of
down of
course
free
not. It's not worth it.
no buy down of free money. We got to 5% and the buy down started to reappear slowly.
Right.
Got 6%, it became a norm in the market. I know I've seen buy downs now for 3 cycles of my real estate life
Of
of 20
course.
years.
Of course.
And this is the time it comes. But also at this time comes programs that are introduced for various reasons, and we don't need to go into that, but for various reasons to help buyers buy properties.
Yes.
But sometimes these programs aren't always beneficial in the long term.
Correct. Correct.
So, talked a little bit about the permanent buy down. Let's jump in to the temporary buy down.
Okay.
And this is where I really want to debunk some of the myths out there
All right.
that the what do you call it? The temporary buy down is a sure fix for everybody, and it's not.
No.
It's designed for a specific type of buyer, for a specific need, for a specific outcome where they can be successful.
Correct. And it's basically, if you want to look at it, it's like, it's when I kind of equate it like this. It's kind of like when the interest, when you're getting a credit card and the credit card company gives you a balance transfer at zero for transferring your balance. And then a year later, bang, it goes back up again. So,
Just 24%,
exactly. So your 10,
right?
I kind of, it's not like I don't suggest it because, like you said, specific buyers are able to take advantage of it. And then there's a criteria that we'll go through with each one to make sure it makes sense for them because everybody's got an individual, focus and individual goal, what they want to do. It allows the payment to be lower for the first year to 2 years, and then once it goes back up again, uh, because of the buy down itself, it's only temporary. Once the interest rate comes back up again, then the payment goes up and you need to adjust for that. So a lot of people, when they look at that scenario that I've presented to, they're like, well, wait a minute, I thought it was, a little bit longer. No, no, no. It's only going to be for 1 to 2 years, and then you got to adjust.
Maybe 3 years, depending,
Right,
right?
and
If you
then you
buy
got to adjust after that.
one, you get 3 years.
Correct. You want to adjust. And then people that get into the 3-2-1 buy down, they're kind of like hoping for the interest rates to actually go down so that they can realize the benefit of the 3-2-1 during the first 2 to 3 years of the loan itself, enjoy a lower payment, a lower interest rate. But then when they come back up again, hopefully the interest rates have gone back down and they can refinance and realize the savings on those. But
Right.
I just look at it from the standpoint is if we're able to do the an alternative way, which is a permanent solution, then you're kind of like in the driver's seat as a buyer and as a mortgage uh, you know person that's paying a mortgage now. If you're able to get into a permanent situation, I kind of always try to advise our customers to go for more the permanent, like the fixed rate loans as opposed to adjustable rate loans, going with a permanent buy down as opposed to a temporary buy down because it's gonna come back and then you're gonna have to adjust. And I'd rather have them, okay, this is gonna be my payment. I've focused on my payment for the rest of the time that I'm gonna be in this house.
Term
And
is
that's
a loan, I know,
exactly.
right?
And you kind of have some security.
Everybody's the same, and some people have different criteria. Some
Right.
people are going to want to look at this program.
And we
So
can
let's
show
dissect.
them. We can show
Yeah,
them the
let's
pros and
dissect
cons.
one for a moment.
Correct.
So a buyer comes and says, I want a loan for $500,000,
Right.
right?
Mm-hmm.
That's an easy round number.
Right. Mm-hmm.
And they think the 3-2-1 program is a great option because they've read it on social media, they've seen articles, people are
Correct.
doing it. And so we say to them, let's look at it. Let's see if it
Correct.
makes sense for
Right.
you, right?
Exactly.
All right. So they get an interest rate broken down for 3 years, their first 3
Right.
years,
Mm-hmm.
right?
Correct.
It's 3% discount on the first year,
Yes.
right?
Mm-hmm.
A second 2% discount on a second year. So now we've gone up 1%.
Correct.
Third year they get 1%. So now it's gone up 2%.
Right.
And in the fourth year, when the loan finishes its cycle of the third year, beginning the fourth year, it's going to recast to whatever the interest rate is valid in the marketplace.
Correct. And that's where they kind of like
And that's where it becomes a little funny.
exactly.
You know, I go back to, and I want to go through the cost and everything else. So when we just look at that piece, it gets me a little nervous to
Of
begin with
course.
because it brings me back to subprime lending.
Yeah.
Now, subprime lending is its own thing. I mean, it's different all the way through. But
Yeah.
the one characteristic that it does have in common is the recasting.
Yes. And what is it?
That is it.
And
And
let's explain
recasting,
it.
everyone, means that you got this honeymoon rate, and bam, you
Yeah.
are in the market rate.
Yeah.
And that's what recasting really means.
And a
So,
lot of banks too, if I may say, a lot of banks are not really into the recasting. You know, they kind of frown on that. And recasting is basically you're doing the mortgage again. You're calculating out a new mortgage after the 3 years.
at the rate, at their qualifications, at whatever's going on,
At that time.
and
Correct.
that could be a very precarious place to find yourself.
Yes.
A
Yes.
very precarious place. So if you are doing this program, the 321 Buy Down, it is a good program for the right buyer.
Correct.
And that right buyer is not one, as in the 2008 subprime lending, hoping and praying that the mortgage rate is going to come down significantly so you can afford the loan. That's
Correct.
not what one program
No,
is
it's
for.
not. No, it's not. It's
No.
and what we'll do with each one of of
Who's
the
who's a good candidate for the 321? What specifically makes somebody a good candidate? Is it someone looking for a bonus for 3 years? Is it what is the characteristic of someone that's going to be successful with a 321 buy down?
an upwardly mobile person that has moved to South Florida that is looking at their situation. Perhaps they just graduated, you know, from college. They have some money saved up over the first 2 years. They know their income. Anybody whose income is projected to grow over those 3 years, then
Hmm.
the temporary buy down will work for them because during the times where their income is not so high, they're able to realize a lower mortgage payment. Once the mortgage payment goes up and they've graduated to the point where now their income level goes up and they're able to assimilate the higher mortgage payment, those are good prime candidates for the program. Also, people that get big bonuses at the end of the year, people that are looking for increases in income, somebody that started a business over the first year, and the first year is going to be a little bit tough, so they need a lower mortgage payment. Once the business starts taking off and they're able to realize good profit and big gains on their business, that's another candidate for this particular program. So it's just looking into the future as far as what your income is going to look like and where it is right now. If you're thinking that your income is going to increase over the next 3 years dramatically, then this is a good program for you.
So you have to be really strong income wise in order to have this program work. And I would imagine that your strategy in the home is also going to be impacted.
Of course.
If you're planning on staying somewhere for 10, 15 years, like you said, Arturo, permanent buy down.
Yes.
But maybe if someone is trying to get into a home, they know they're only going to be there
Yes.
3, 4, 5 years.
Yes.
They have a huge amount of income. They know they're getting bonuses.
Right.
They know they're going to get a promotion in the next year that's going to bump up their salaries
Right.
significantly. Could be a nice niche for them.
Exactly. And also people that are looking at it from the standpoint, I'm going to be in this property maybe 3 to 5 years or less. In the three to like year number 4, if they purchase a property and they wanted like they purchase it as a starter home, for example. So they're into it at a lower interest rate. Once the payment kicks in, they're able to sell their property and move on to a more permanent situation for them.
Right.
That's also an option out there for them.
Yeah, and that's strategic. You know,
Yes.
that makes sense. If somebody came to me and said, "This is my plan," I'd be like, "Oh, temporary buy
Yeah,
down, 3, 2, 1
exactly.
might make sense for you."
Yeah.
You know, so again, it's for a very limited number of people,
Yeah.
someone in a very strong
And
niche.
that's what we discussed when we were talking about the 321 buy down. It's like specific, buyers are going to have needs. And then we are able to, by interviewing them and speaking with them and what their personal goals are and what they're looking to do, we kind of custom fit a program for them, whether it be a temporary buy down 321 program, or if it's a buy down program for a permanent situation, those are the deals that we structure it and we make it fit for their needs, whatever their needs are.
Right. And the type of loans, it's valid for any loan,
Yes,
correct?
correct.
And
Yes,
the adjustable, the fixed,
yes.
FHA, does that qualify as well?
I believe it does too. Yes. Yeah.
The one I'm not sure about is VA. Does VA have the buy down?
Then I
I
have to
don't know.
check. I'm not
Yeah,
100%
but
sure on that.
definitely FHA, conventional,
And
uh, and adjustable.
yes, correct, correct.
Okay. All right. So basically, any program that's out there for the massive populations would be able to take advantage of this program if it
Absolutely.
makes sense.
If it makes
If it
sense and fits their needs, yes.
Thank you, Arturo. Thank you for debunking the myth that we are seeing on social media everywhere. But before we go, and before I thank you for being here, I'd like to give you an opportunity to talk a little bit about guaranteed rate and anything you would like to share with us that makes your program and makes you a little bit different than everybody
Well,
else in the market.
we're partners, first of all, with the great people at Coldwell Banker. And that
Yeah.
makes a big difference for the customer because, as I mentioned jokingly to Athena before the camera went on, is like for those realtors that are out there right now and customers that are out there right now not getting the feedback from their loan officer, Athena can walk over to my desk and say, "What's going on?" Because we're under the same roof. That's one of the benefits. But what we try to do, we're the second largest commercial lender in the country. What we try to do is give you competitive rates. And at the same time, what we try to do is like, and this is one of the secrets that I use for with our customers is like when our borrowers, we get them a pre-approval and they're out there looking with Athena for properties and what have you. Once you have a property that you have looked into and you say, this is the one I want to make an offer on, before you make an offer, what we offer is we go ahead and we do an analysis. I get with Athena. She looks at the HOA costs. She looks at the insurance, what the insurance might be. What are the taxes on that property? So then before you make an offer, we're gonna give you a loan summary where you're gonna know probably within 1 to 2% of what the actual mortgage payment will be if you make an offer, so that you know going in before you make an offer, you know exactly what your mortgage payment is going to be. There's no guessing. We're going to be able to pinpoint exactly what the cost is and then discuss those options with you, whether they buy down permanent ones to get the mortgage payment as low as possible so it fits your needs and customize a loan for you. And then once you see that and you're comfortable with it, then you go ahead and make your offer because you know exactly what the numbers are going to be going down the road, as opposed to here's your pre-approval letter, good luck. We don't do that. We walk
Well, it
you
makes
through the
a
whole
huge
process.
difference. And I'm going to just piggyback on that for one moment. The difference in working with a lender that I can see eyeball to eyeball is amazing. Because if there's something that happens, and there's always something that
Of
happens in our
course.
real estate world, we can have a conversation.
Yes.
But more importantly, what Arturo is offering is something you can't get from Quicken Loans. You can't get from a mortgage broker online. You can't get it from a mortgage broker that is in a different area outside of South Florida. And what that is a true calculation of what the insurance is going to be and what the taxes are going to be. I can't share in many times that I have seen a mortgage come back, what do you call it? A calculation. I'm like,
Yes.
$1,800 a year for insurance? No, this is South Florida. It's not $1,800 a year.
Yeah.
And that makes it big different for
Huge
some buyers
difference. Yeah.
to have that calculation correct.
Correct.
So, getting that document, it spells it all out.
Absolutely. And
Spells it all
you're
out.
giving our customers a the expectations of what it's really going to be. So we eliminate those surprises down the road that you mentioned.
Yeah, we don't want
No.
surprises. No surprises. We want surprises.
Exactly.
Well, everyone, I want to thank you for joining us today. I hope that you found value in understanding what the 321 buy down is and how it differs from the permanent buy down. If you have any questions at all, Our contact information will be into the comments below, and you can book a call, you can call us, whatever makes you happy and whatever easier. Arturo, thank you for joining us. I hope you consider coming back and sharing some more wisdom with Guaranteed Rate.
It would be my pleasure. Thank you for the invitation, and I really enjoyed our time together today. And the next time you need another conversation with me, I'm ready.
Okay, well, we'll see you soon then.
All right.
Thanks. Bye, everyone.
Bye, everybody. Thank you.